Oilfield services are the evil stepchild of oil investing, underperforming crude prices, the S&P, and its oil peers. They are all rethinking their business models to account for a world of capital discipline from U.S. shale producers, peak production fears in the Permian, a falling rig count, lower oil prices, and climate change. Enter Baker Hughes. It's placing its future on the energy transition. Here's how. Liquefied natural gas, LNG. It makes the turbo machinery that's needed to build a liquefaction facility where natural gas is turned into or out of liquid. And carbon capture. It makes products and services to help customers monitor and reduce emissions. The bulk of the revenue still comes from upstream, and that might come in weak, but turbo machinery and process solutions revenue could grow at least 20% this year. It's also committed to its own business to net zero carbon emissions by 2050. It's the only major oil services player in the LNG space, and hopes are it can stay the leader and win over investors while doing it. I recently caught up with Lorenzo, Baker Hughes CEO, at the company's annual meeting in Florence, and we talked about the power of digital.
Our distinguishing factor is when you look at our digital solutions business, we have also the hardware and software aspects.
Mm-hmm.
So it's
Give me an example of that. What does that really mean?
So what that means is you've actually got the sensors from a hardware perspective, and then you've got the software relative to condition monitoring. Mm-hmm. So we are, I think, the gold standard when you think of condition monitoring through Bentley Nevada, and you've got the System 1. We just released the Orbit 60. So these capabilities allow uptime, allow the reliability and efficiency to be there for our pieces of equipment. That's very different than some of our peers who really are going from a geological reservoir perspective. They don't have as much on the equipment side.
Meaning that they focus on like what rock you want to drill best.
Correct.
Versus...
They focus on one area. Our portfolio is much broader.
How much money do you think that your clients are going to spend on digital going forward?
You know, I think they're going to continue to invest. To put a number on it is difficult, but you look at all the surveys and the interactions we have with our customers is, you know, you can get a very nice return by focusing on digital.
Growth rate then, if you don't have a number, like growth rate.
Look, we expect again, we've said it before, we expect our digital solutions business overall to be GDP plus 1% to 2%. If you look at the digital component of it, you would expect that to grow at a faster rate, just because it's coming from a lower base. But we need a few years to actually make it scalable.
Which one are you most jazzed about? I know it's like picking between kids, but like if there's one that you think is really going to take off that hasn't been yet adopted that you're most excited about, what would it be?
Digital transformation. The ability to really take the data that's out there, make the algorithmic sense, and predictive anticipated results. Outcomes are what matters.
And is that more to, like you're going to replace equipment before it breaks? Is it knowing there's going to be a leak before there's a leak? Is it that?
It's that, but then if you think about being able to continuously drive production without stoppage, downtime is your worst enemy, non-productive time. Also in processes, the inefficiencies that happen because there's stoppage in the handover. We've got an opportunity now by taking a digital view to actually bring down that MPT, and that's going to enable higher production.
From where you sit, do you feel like U.S. shale has peaked for the oil services sector?
You know, there's different scenarios that people are looking at. 2020, we see North America E&P spend down double digit. I think most of us see that within the industry. As you look at production, it will vary by basin. And I think right now it's more an aspect of let's continue to drive productivity. And we'll see how this year unfolds. But there's clearly challenges that are emerging on the North America side.
So I hear that says too early to call a peak, but ...
I would say too early to call a peak, and it's going to vary by basin, but there are some challenging times in North America.
Can you give me some insight? I'm trying to get a good read on are the wells that people are drilling today better or worse than they drilled a year ago, in whatever capacity, whether their IP rate is higher, but then their decline rate is steeper. Do you have any insight into that yet?
So again, the variation by basin is tremendous, and I think the E&Ps would be in a better position to give that to you. Our focus with them is drive towards productivity. And so how can you actually drill a faster well? How can you bring it online faster? And if you look at our portfolio, again, we're much more on the production side, and so we're less sensitive to some of the aspects of the E&P spend decline. So we'll outperform the market from that perspective, but productivity is the name of the game.